seminario comenzará en breve. Por favor, permanezca en línea.
Probando.
El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. El seminario comenzará en breve. Por favor, permanezca en línea. La emisión está comenzando. Todos los asistentes están en modo de solo escucha.
Webinar is all about global carbon credit markets, and I'm delighted to have back on the program after a couple of years, Luke Oliver from Crane Shares. Welcome, Luke. How are you?
I'm well. Thanks for having me back. Looking forward to talking about this.
Tell the audience a little bit about what you're going to cover today.
Well, today we're going to talk about the global carbon credit markets, but what that means is it's an allocation that is pretty much absent in most retail and intermediary type portfolios. And of course, when I get into some of the details, you'll see why the institutions and the ultra high net worth family offices are investing in carbon, because this is a very low correlation to equities and with very high expected returns over the next 10 years. So this is an asset class to watch. And of course, it's not a niche market. It's $1 trillion market in terms of trading volume. So that's what I'll be getting into. And I think it'll be very interesting for many of your viewers.
Yeah, I sat through one of these about 2-3 years ago, and it was absolutely fascinating. So I'm looking forward to hearing what you've got to say and what the update is. But before we do that, Luke, if you wouldn't mind putting up the IBKR disclaimers on the screen for the audience. We're talking about investments and asset classes that may involve risk, and we're always duty bound to put these disclaimers up on the screen. Today's session is live. It's being recorded. You'll receive a link in your email a couple of hours after Luke has wrapped up talking today. So do look out for that. That's going to take you to the IBKR campus, and you're going to look on the previously recorded webinar page for all of our prior events. And you can also locate those according to the contributing source as well, of which Crane Shares is a wonderful partner for us. And please do type your questions for Luke into the GoToWebinar chat panel, and I'll handle those, and we'll do a Q&A towards the end. Luke, if you'd like to go on to your opening slide, I'm going to go on mute and hand over to you.
Thanks very much. I'll take it from here. So yeah, again, thank you all for joining us. This is a great partnership with Interactive Brokers, and this is what we really focus on at Crane Shares. Of course, what we've done recently is launch in Europe our exchange traded commodity carbon fund, KRBN. That's our global product, which follows on from our launches in the US, where we also have a full suite of European and California as well as the global products. So what's important to us is that we really find allocations that are underserved by the market and underallocated by the investor. And of course, the firm built its reputation around China, and of course, China is incredibly interesting right now, and surprisingly has been the the favored allocation in this new Trump administration, which I don't think anyone would have guessed. But within this area of an expertise in China and alternatives, and specifically in carbon, is we were the first to launch carbon allocations, and we've been one of the more successful analysts in putting out content in this market and raising assets. So we'd love to hear questions. Please do send them as we get a little further on. So just high level, just kind of hit the high notes here. What is carbon all about? Well, there's a few different parts to this market, but high level, this is a $900 billion futures market in the carbon credits themselves. The major markets are Europe, California, the UK, the northeast of the US. It's a group called RGGI, about 12 states in the northeast of the US. And these markets continue to grow. But if you include the primary auction of these allowances by the government, you're easily getting into $1 trillion of market value of trading in this asset class. So highly liquid, highly institutional asset class. And as I'll show you, there's some great return expectations and very low correlations to US equity. So that can be, when you're building a portfolio, of course you want high return. But having low correlation is what really creates a great portfolio versus one that's got concentrated risk. And so this is really interesting for us, and I think you'll see why these institutional investors are making allocations. And of course, the other part to this is there's nothing that has more impact on solving climate issues than the price of carbon. And I'll explain in a little more detail in a few slides here. But high level, we've got something that has a high return, low correlation, and is also incredibly impactful, but in a true way, in a capitalist way, not in a do-good way, but in a way that is actually going to finance the transition to a lower carbon industry. So first off, I like to, and please, do send questions. We will get to them. First off, I like to differentiate between the two different parts of the carbon market. When people say carbon markets, there's this $1 trillion piece that I'm going to talk about, which is huge. It's institutional. They are completely regulated. The credits are all standardized and issued by governments. They are all backed by law. So the supply is governed by the government policy on what the supply of credits is going to be. And the demand is regulated by law in each of these markets that we cover, where companies that pollute in those economies must buy carbon credits. Not above a cap. There's just a single cap for the economy. They issue those credits at auction. They get bought by the compliance companies. So think energy companies, think industrial companies. And then they can trade them amongst themselves. But ultimately, at the end of each compliance period, they have to submit as many credits as they polluted tons of CO2 or equivalent. And that's a very simple process, very much like paying taxes. You use something, you can record and audit the amount of carbon that you put into the atmosphere, and then you have to buy the appropriate number of credits. And that's a very robust program. That was always the first time I learned about this. I said, that sounds difficult to regulate that. It's actually very simple, and it's very robust, and has been in place since about 2007 in Europe, and a little later in the US, but very robust process. So you have something that is backed by law on the demand and supply level, so you can forecast it like a real financial asset. That's why we like that market. The other thing that you may have heard of is carbon offsets. This is where Starbucks and Microsoft commit voluntarily to reducing their carbon footprint by not only reducing their pollution where they can, but putting investments into forests or forestries or carbon capture. Now, very interesting, very powerful, but ultimately that gets all the headlines when people talk about carbon, and it's less than $2 billion in traded volumes each year. And so it's a tiny market, borderline insignificant compared to this market that I'm going to focus on. But I want to mention it because it gets all the headlines, and that's thousands of forestry projects all around the world, different standards, very little consistency. And that's why that to us is very interesting, but it's not really an investable product for the masses. It's not really an asset class. whereas compliance certainly is. And that's really the key. I often meet people and they say, oh, I've heard about this. There's a guy growing a forest, but you have to trust him that he's growing the forest. You don't have to do that with what we're talking about today. These are government issued assets. So from the European Union, from the state of California, which itself is one of the largest economies in the world. So moving on, you could just see here, I'll spend 1 second here. These programs are growing rapidly and are consuming more of the global geography. And even within those geographies, it's consuming more of the economy. So for instance, in Europe, maritime is being included. Airlines are being considered. There's a global airline program that's going into place. In addition to the 4 majors that I mentioned, there's also Washington State is sort of our 5th major. And then you've got Australia, New Zealand, China has a program. And you can see there also, Japan and others, and India and others are starting to set up these type programs. And as you'll see, when we talk about tariffs, which is incredibly topical right now, we're actually seeing a sort of carbon tariff emerging. And it's a fairly non-controversial one because Europe is putting a carbon tariff on those importing into Europe. And what it encourages is actually a reciprocal tariff. So Europe actually will discount your tariff from its tariff. So it's almost a friendly non-trade war tariff system that's emerging around carbon. And of course, if you believe in sort of this deglobalization, it's actually quite interesting because a lot of the reason that things are much cheaper to make in third world countries is that you get to ship it very cheaply versus making it domestically. But if you start pricing in the carbon emissions of all that shipping, you start to change the picture of it. So this is very much pro the direction of travel that the global economy is taking. Despite, some people think, oh, this is climate, this is sort of the opposite of capitalism. This is very much attuned to the global transition from coal to gas, from bringing back some of that manufacturing overseas back to domestic markets. So very interesting and very likely for that reason to continue being supported as well as it has been. So I did spend more than 2 seconds there, but conscious of time, I want to keep us moving. This chart, I hope, illustrates in the simplest way how these markets work. So take the European economy. Going back to 2007, Europe introduces this program and they create a cap. Now that cap does not tell any individual or any company what they need to do. They simply say, we are only going to auction this number of credits each year. And then to hit our target by 2030 and by 2050, we're going to taper and tighten that line. So what that means is that companies in that economy will have to buy these credits and they will have a simple choice. We can just buy the credits. But the risk is, as the market tightens, those credits get more expensive. Or we can go and buy these credits now while they're cheap and hedge our position while we decarbonize. Or we can decarbonize as quickly as we can. And whoever is more successful at decarbonizing will have the best economics and the best competitiveness in this future environment. So in the early years, you can see at the far left of the chart, you can see that the cap was very generous relative to emissions because they wanted it to be cheap. They wanted everybody to be able to manage the process. And they wanted everybody, if they chose, to buy more credits than they needed to hedge themselves for the future. And then over time, they tighten that market. And as that market tightens, it starts to cut into the actual emissions. And that's the sort of the inflection point that we are in today, is where these caps are now coming in lower than the emissions, meaning that instead of being in a environment of ease where the credits are quite readily available and you can build hedges, we're now in the mode where you start to need to use your hedges and the credits become scarce. And that's where we have liftoff in prices. And so the outlook forward is that this price continues to tighten. I love this story that RWE, Europe's largest energy company, they hedged all of their exposure to this market for the next 10 years at about 18 euros a ton. The current price today is, I think it's in the 70s here, and 69.01 today. They've made a significant return on those hedges. Now, some people say, well, okay, so the big energy companies smart and they hedge so they can keep polluting. How does this help? Well, this is the beauty of this. Either the price gets higher and companies need to figure out quickly how to not pollute, or if you were smart and hedged, well, you can keep polluting and you've got those cheap hedges, but wouldn't you rather sell that thing for 69 euros and profit from the 18 euros you paid for it? Or would you just like to use it? Because if you use it by continuing to pollute, you don't get to profit from that return. You just get to use it for 18 euros. So even the companies that were smart and hedged, it doesn't give them free rein to pollute. Their shareholders are going to demand that they actually monetize that by selling them at the profit. To do that, they need to reduce their emissions. So whichever way you cut it, this keeps the incentive on companies to be as efficient as possible on their emissions. And this is another key point, because especially I'm in the US, and everyone I meet in the US is very polarized around, is this a left-leaning policy or a right-leaning policy? This policy, this asset class, is based on the free market pricing of those emissions. So this is not a ban on fossil fuel. This is not a mandate that people have to reduce emissions by a certain date. It's simply saying that we have a regime in place that is this $1 trillion market which prices carbon. You internalize that previously externalized price, and you can do what you want. But if you're smart and you want to make money, you're going to optimize for pollution. And that's the key word. Every company in a capitalist society, in any society really, will optimize for how many people they hire. They'll optimize for how many vehicles they have, for the real estate footprint they have. And because of this mechanism, they now have to optimize for how many tons of emissions that they put into the environment. And that's all it simply is that mechanism, that pricing mechanism to create the environment that companies start to optimize for pollution as well as everything else. And by doing that, and companies are great at doing that, we're going to drastically reduce the amount of emissions going into the atmosphere. So you can see some of the big companies that are involved here, but it's pretty much every major polluter in every economy, which is pretty much every company. Here's why it works so well from an impact perspective, is because by selling these allowances, governments create an auction revenue. So they create billions of dollars of revenue that they then put back into, whether it's a waiver or a rebate on buying an electric vehicle, or discounts on putting solar panels on your roof, or even just various sort of regenerative watershed restoration type projects, and also retraining people, moving from dirtier as technology improves, moving people from dirtier, more polluting jobs to cleaner jobs, and that's where that money goes, and that money also is very attractive to policymakers. So even those politicians tempted to be against these kinds of policies, they like that money, they like that revenue that comes in, and so this program really is sort of aligning everybody's incentives to do the right thing, and not relying on people being good, just relying on people wanting to make money. And as we all know, unfortunately or fortunately, that incentive is the best incentive that gets the biggest results. So secondly, you have fuel switching. This is the basic mechanism. Coal, when you burn it, has double the emissions of burning gas. And therefore, if you burn coal for power, you're going to have to buy 2 credits. Whereas if you use gas, you're going to buy 1 credit per unit of electricity. So what that does is make the dirtier fuels per unit of output more expensive. And so naturally, as the price of carbon rises, it favors the greener fuels. And ultimately, as the price rises, companies and power stations and everyone is going to try and seek ways to shift from, say, coal to gas, and from gas to renewable. So it really starts pushing the needle towards those greener fuels. So that's the basic mechanism. We're seeing that. Obviously, very disruptive during this Ukraine crisis, because we've had gas disruptions going into Europe from Russia. But that's starting to stabilize now, which is very good for this market. And thirdly, and I think this is the most exciting part of this whole story, is as that price rises, you suddenly have a value to reducing emissions or capturing emissions. So there's a huge arms race of capital being invested into green technology. So we're really accelerating the flywheel of innovation, and whether that's modular nuclear, whether that's carbon capture and storage, we are really improving the cost to bring down pollution, and kind of as the market fights against that rising price of carbon, we get to be long the carbon, which has all the impact. But actually, by doing so, we're actually having an incredible impact on the amount of pollution. We're creating the environment to allow industry to actually monetize getting cleaner. And this is something Goldman Sachs puts together. This is what they call the marginal abatement cost curve. And this is for each industry, at what cost in today's technology can they decarbonize? And so what it really tells you is how expensive does carbon have to be for these companies to care and do something about it. So you can see on one hand, right on the far left, you've got negative bars. And that's great, right? As soon as there was a price on carbon, these companies woke up and said, actually, we should just change filters. We should just switch fuel. We should just do these very cheap things that are inexpensive, and immediately actually make more money and avoid this carbon program. So you see that, right? That's the lowest hanging fruit. Then you have simple things, relatively simple things, like switching from coal to gas. And we're kind of in that zone. So we always see carbon prices, coal prices, and gas prices having a bit of a relationship, because as carbon goes up, more people stop using coal, start using gas. You might see gas go up. If you see gas come down, people might accelerate to buy more gas and therefore pollute less, and you might see carbon come down. But then you might actually get a boom in industry because gas is so cheap or cheaper, and that will increase demand for carbon. So you get this interesting relationship. So it plays very much into commodity like exposure, but as I'm going to talk about later on, very different economics, much smoother, lower cost way to access this sort of energy transition that's going on. So of course, commodities can have some very violent futures curves that make it very inhospitable to try and be strategically long. Carbon looks much more like a currency when you look out the forward curve, and so much more stable than the commodities are. So, but as you move up this curve, you can see this price of carbon. So just to give you a hint, the average price in our portfolio is about $50 or 50 euros, give or take, a ton, because it's blended with these different markets that are cheaper than Europe. This chart suggests that 1400 is where this price of carbon needs to get. So good and bad news. I don't think it ever gets that high, but that's a good thing, because we don't want to damage industry by making carbon too expensive. The Goldilocks scenario is that the price of carbon rises, but because of the innovation, these bars start to come down and start to flatten. So I don't know if you can see my mouse here, but I'd like to see us land somewhere in here where the price of carbon ends up from $50 today to something like $300 or $400 by 2050. And yet we've smoothed that curve and we've got all of the emissions out, but we still have all the cost of living hasn't increased. We have all the resources, we have all the power we want, we have all the food we want, we can all go on vacations and fly in planes wherever we want, but we've done that without the emissions. And that's what this seeks to do. Some of those things will be harder than others, but what you want this market to do is keep pushing up the curve of low-hanging fruit until we keep solving these things. So this is the most impactful thing you can do. Very quickly, I just kind of really want to introduce our strategy at this point. We have these 5 markets: Europe, California, UK, RGGI, which is the northeast of the US, and the new state of Washington. And you can see here, 2024, about 800 billion in trading. As I said, add the secondary market, add the primary market, and you get that up to about $1 trillion. So this is kind of how we weight. Europe is by far the core of the portfolio. California has a very exciting upside story that pairs very well. And then these other markets are much smaller, so we kind of keep a sort of token 5% allocation there. We do look forward to seeing markets like Australia, New Zealand, even China, which arguably is the biggest market, but it's not there yet in terms of liquidity and development to be included. So this is going to be dynamic, and KRBN is giving us an allocation to these 5 markets. So where I'm sort of going to go from here is just really, I'm going to talk about the Europe and I'm going to talk about the California allocations because they're the two biggest. They make up close to 3/4 of they make up much more than 3/4 of the allocation. And so this is really where the focus should be. There are smaller opportunities. I'll touch on the others, but I want to talk about Europe. It's the biggest market, it's the most liquid market, and arguably it's the market that's going to keep grinding higher and higher over this period between now and 2030 is the next hurdle, and then 2050 beyond that. So let's talk about Europe. So Europe, its target is to reduce emissions by 40% relative to 1990. And they are adding more markets. I mentioned maritime is being added, and they're also phasing out the process whereby a lot of people say, like, what stops a company just leaving Europe and just saying, if I move over a border and I don't have to pay this anymore, why wouldn't I do that? Well, this is what Europe's addressing. By the same token, if you've got, say, German steel, and people are buying German steel, but German steel is getting more expensive because of the price of carbon, why don't I buy Indian steel and import it? Well, Europe's solving for that. What they used to do was give cheaper free allowances to those companies that had that competitive risk to give them a bit of a discount. They're removing the discount, but they're putting what's called CBAM, the Carbon Border Adjustment Mechanism. And so this is what I mentioned earlier about tariffs. Europe is putting a carbon tariff equal to its domestic carbon price. So it's charging, it's not switching competitiveness. It's saying our domestic companies have to pay this price of carbon. And if you want to sell goods in Europe that were made elsewhere, then you've also got to pay this price. And so what they're doing is putting that carbon tariff equal to their carbon price. Now, and I'll use India as an example, if India said, well, we'll introduce a carbon price, Europe will say, okay, the tariff is now our price minus your price. So as long as their price, if they match their price to Europe's price, then there'll be no tariff. And so what that does is allow that country to grow revenues, but levels the playing field. And you start to get a global price on carbon, which is very powerful. So Europe is starting to kind of back into creating a global. If you want to use the European market, on the goods that you bring to Europe, you have to also pay this carbon price. So that is the development that's going to start in 2026. I think it's going to be huge for prices. I think we're going to see, why is that huge for prices? Because all these global companies are also going to have to participate in this market, and their best hedge will be hedging in the EUAs, the European Union allowances that we buy in our fund with a 60% allocation. So we think we're going to see demand and demand supply imbalances tighten. And so it's a lot of sort of commodity speak here, but we think those demand supply imbalances are going to structurally get tighter and tighter, especially starting next year. And obviously, as it's starting next year, people are going to start pricing that into the market this year. So lots of tightening. I always show this. I'll explain what it is, and I'm always happy to take offline and get into some of this in more detail. But what you've got here is the cap. So the pink line or the purple line at the top is the cap coming down. This is Europe forecasting tightening. But that doesn't tell you the story on its own. If that line is going down, that should mean prices are going up. However, what you really need to look at is the black line. The black line is the cumulative surplus in the market. So surplus is fine. It's just how tight is that surplus. So you can see, because of the great financial crisis, the amount they were auctioning ended up being too much relative to the amount of economic activity. So the surplus really ballooned. You can see from 2008 to 2012, the surplus grew. But since then, as the cap has come down, they also introduced what's called the market stability reserve, which is if the surplus, the black line, is too high, they take 24% out of every auction. So there's a very strong tightening mechanism that has been in place and continues to be in place today, that is really causing that black line to go down. So the steeper the black line falls, the higher the prices rise. And you might wonder why I circled this area, because the reality is EUA prices have been rising rapidly, with the exception of 2023, 2024. And the reason for that was the Ukraine invasion meant that there was a stranglehold on gas. Gas prices went so high that they didn't make the switching from coal to gas work, and they also just killed certain parts of the economy that relied on gas. And so you had this two things happen. One, you started to have a drop in economic activity. And secondly, and more impactful here, was Europe then adjusted the policy to put a bit of more easing. So you can see the black line's still going down, but what they did is, but the simplest way to say this is they took the auctions that they were going to hold in 2026, 2027, 2028, and front loaded an extra 100 million or so in years 23, 24, and 25. And so what that caused was that black line to flatten a little bit. It originally had been steeper, but they flattened that curve. And so on that flattening of the curve, i.e. not falling as much as people were pricing in, we had the sell-off in prices. So to put that into context, we're trading at about 69, 70 euros a ton today. The norm in 2022 and prior, we were in the sort of 80 to 100. And if I go to the next slide, and you can see here, again, I don't know if the mouse is visible, but once you come out of this bubble, and we are in 2025 now, which is the last year of the lesser tightening, and the stricter tightening starts again next year and is even tighter than the pre-2023 because it has the normal tightening plus the easing we had is coming out in 2026. So in 2026, 7 and 8, we're going to see accelerated tightening. We're going to start seeing that being priced in today. So that's why EUAs are starting to move back up again. And where do they end up? You can see here the forecasts. Most folks priced in or forecast that the Ukraine would create this sort of divot in prices. But as we exit, as we come through 2025, we exit that policy, we should see prices rising again. And you can see that, generally the street thinks we could finish this year and next year around the 100 euro mark, up from 69 today, which is a significant return, and up to 150, 160 by 2030. So we think we're going to see a new sort of golden era of these EUA prices, like we saw in sort of 2019 to 2022, and would have continued had it not been for the Ukraine invasion. So we're back on track now with Europe. So we're very excited about Europe as our largest allocation. Now, our second largest allocation is California. Again, we're in the midst of a release of even more policy making, and we're starting to see that we're going for a 40% cut, similar to Europe, but in fact, California is pushing through an adjustment to 48% target versus 1990 levels by 2030. So that's what we're waiting on. We're waiting to see this like aggressive shift from already aggressive to very aggressive on reducing those emissions. And again, the reducing emissions, all it does is create the economic environment for companies to do that in an economically viable way. So just to put it into, even though going from 40 to 48% target, it's a 20% increase. It doesn't sound that mind-blowing, but what it could do to the tightening mechanism is we go from like a 4% to like a 9 to 14% tightening. So that's quite material when you push that through policymaking. And California has also said they're going to do that via the cap. So let's look at the same chart. And California has one last very interesting element. But let's look at the same chart here. The pink line, purple line is going down, just like it is in Europe. However, in California, we are only just shifting from surplus to shrinking surplus and towards deficits. So this is an inflection point. This really is the sort of you are here. The amount of credits being issued and the amount being bought and needed every year have hit that inflection point. So from here on, companies don't have the luxury to build hedges. They're going into scarcity mode, and that's when prices will start to lift off. And so you can see there's this point where the curve rolls over. We are in that point. The point here is suggesting that in 2026 we hit this sort of flat line in supply, and then market starts really tightening. And that's why we're starting to see a lot of traction in 2025 to invest in California. But there's one more very powerful reason why people really like this California allocation is you'll see here as well that the surplus gets to negative by 2032. Let's go to the next slide because this is interesting. In fact, I'm going to zoom in. California also has a floor price, and it also has a ceiling price. And so today, California is trading around $30 per ton. The floor price is trading at $26 a ton. Next year, that will step up to $28 a ton, and the year after that will be into the 30s. So California has an entry point today that will be below the floor in just 3 years. So in other words, your downside today is the difference between 30 and 26. And with each year, the floor price steps up by 5% plus CPI. So we've got a 3% inflation print. That's an 8% lift up. So your sort of base case, or I call it the bear case, in fact, you can buy something that has a floor price just below where we are that's rising at roughly 8% per year. So that's very compelling. And that's why you see sort of family offices looking at this and institutions saying from a preservation perspective, our downside is a plus 17% to 2030. That's the boring side of it. Like my downside is positive. My upside, there's a ceiling price, and that ceiling price also goes up by 5% plus CPI. It's in the 90s today, and it'll be in the the mid hundreds by 2030, and that keeps going up by 7, 8, 9%, depending on what inflation is, all the way on to 2040 and beyond. And so you get this very asymmetrical trade, which even to I can't see the edge of my slide here, but I think it's about 400% up to the ceiling price right now. And in between here and the ceiling are two tiers that are kind of aimed to be resistant. So they want the market to get to the ceiling over time. They don't want it to get there too quickly. So it's strange. I take comfort in knowing that this investment is designed to go up to the ceiling, but they're going to slow it down a little bit. And in theory, I don't want it to be slowed down, but I'm comfortable with it because by them having resistance bands means the confidence in the market reaching those points, and also it keeps the market stable, keeps the market palatable for this kind of modest transition over the next decade. And so that means the market has more longevity. And so I really like that. So what that means is when I showed you on the previous slide that the surplus, the black line, cuts through the axis there around 2031, 2032, means that we should be hitting that orange line as a base case for the 2031, 2032. If you discount that back to today, you're going to be above today's orange line. So in the next 2 or 3 years, we think the California prices will have this bear case of being flat because the floor will come to rise to us, and our intrinsic value will be that orange line, which will be somewhere in the 70s by in the next three years. So it'll be it's at 60 today, and it's going to go up by that 8% a year for the next 3 years. So I think there is a great long-term story here that works out to be something like 25% annualized. But I think a lot of that will be in the first few years here. So very, very topical. Just to flip back, you can see the forecasts. They're comparable to European forecasts. Remember, we're at a lower price point in California today. And so here's the other markets. Black lines all heading downwards. That's positive. You want to be in markets with black lines going downwards. That means supply relative to demand is favorable, and these unlike a commodity. In fact, let me talk about this here. There's a whole lot of markets. I don't want to belabor this too much because I know I've thrown a lot of information out here. But here's something I sort of want to show you. I'm going to start bottom right, just quickly get this out of the way. People talk about futures, and they talk about futures curves, and they talk about contango. These futures curves are relatively flat because they are financial assets. They do not go bad, unlike a lot of agricultural products. They're cheap to store, i.e., it's like holding dollars. There's no real cost to holding them, and they're cheap to transfer because it's a financial asset. It's not a physical heavy commodity that needs to be moved. So its futures curve really just looks like the cost of money. So if interest rates are 5%, a 1-year future will probably be about 5% more expensive. However, even 5% sounds like a lot. We're not levered. That's only if you're paying for leverage. But we're using futures for their liquidity. So we are long the futures, but we only have to place a small amount of margin for them. So we might pay the 5% cost of the curve on the position, but we have most of our capital. The margin's sort of 15%, give or take. So the other 85% of our assets, we can invest in ultra short dated, ultra investment grade bonds and earn back roughly that 5% and 85% of the portfolio. So what does that really mean? And this is really important because a lot of people say, isn't it expensive to hold these types of positions? Not carbon. Commodities, yes. In carbon, we're earning back most of the cost of the curve. And so you can see here, it's not free, but relative to commodities, you've got something sub in 0.9% is the cost of carry in those futures. But also don't forget, like the indexes bake that in as well. So we're not dragging to the index by that or anything like that. We simply the sort of cost of accessing this asset class with these high return expectations is about 0.9%. And I think that could even come as rates come down, as these markets continue to grow in liquidity and prices go higher, then I think that becomes even smaller. But I think it's a very reasonable friction point given the asset class. So the next thing to note is that, and this is why I kind of mentioned commodities quite a bit. Commodities are expensive to hold, and they don't really have expected returns. Commodities are a great inflation hedge, and they're a good diversifier. They have low correlations. But really, if the price of oil goes up, they'll pump more oil, sell more oil at that price, then they'll oversupply it, and the price will come down. If it's soybeans, gold, you name it, they will shift the supply to match the pricing. So as people say, the solution to high prices in commodities is high prices, because then people will supply more at those prices and correct for it. So that's why commodities don't really return anything long term. And in fact, because they're expensive to hold, they actually create drag. If you replace commodities with carbon, you've got all the diversification benefits, except this commodity, they're never making more of it. It's a commodity that they are in one tightening cycle till 2030. And so as prices rise, the climate action that the market is striving for will come into play. And it's not to say we won't have some volatility. It doesn't mean this is a one-way escalator to those high prices. We've seen it, the Ukraine created volatility, for example. But you do have expected positive returns, which is very different to commodities. So we show there on the bottom left, you put carbon in a portfolio versus commodities, or most other alts for that matter, and you get this really interesting moving the efficient frontier up and out to the left. You get an improved portfolio. So then let's talk about, and I'll probably leave us here because I think this is really key, and this is why so many institutions are looking at carbon, is because even if you forget the word carbon, you forget climate action, and you just say, I'm a risk return guy, I just care about risk and return. Well, historical returns have been about 19% a year. We think this next period will be a little higher than that. 20 to 24% will be the sort of annualized returns over the next few years. So even higher than historical. But the volatility has been about double that of equity. So roughly, double equities, but double the vol. So your Sharpe ratio, you've got 0.71 versus 0.8. Similar Sharpe ratio to US large cap equities historically, and also we believe looking forward into the future as well. And yet it has a correlation. If you look at the chart then, so that was the chart on the left, the table on the left, table on the top right, you'll see correlation to US equities is 0.29. So if you can have a similar Sharpe to US equities, with a 0.3 correlation. That's a dreamlike allocation to be able to allocate something that can bring down the vol of your portfolio, despite the fact it's volatile itself. Those risk return, that sharp, that correlation is something very incredible for a portfolio. And the return in absolute terms, if you don't care about vol and you don't care about correlation, it's a much higher return expectation than there is in most equity markets. And then the reason we like the global benchmark is because you can see the correlation between the individual carbon markets is incredibly low. It's even lower. You can see it at 0.1s and 0.2s and things like that. So as a pure investment from a completely intellectual perspective, carbon makes a lot of sense. If you layer into that the fact that we understand the fundamentals of why this market should continue to tighten, and we care about the climate impact that it's having, there really is a strong case to have carbon in your portfolio. So once again, ticker is KRBN, and I'm going to take us just back to the beginning here, and sort of happy to take any questions. But yeah, KRBN is the ticker, and these slides are available on our website should you like to get copies of it. So maybe this is where I hand back.
Hi, Luke, that was excellent. Thank you very much indeed for presenting fascinating series of slides there on the business that you're directly involved in. And as Luke says, please do put your questions into the chat panel. Let's see. Luke, is now the right time to be getting exposed in a portfolio to carbon?
Yeah.
How do you time that?
Yeah, well, so you could argue any time on this tightening cycle, especially since we hit this inflection point where we're going from surplus growing to surplus shrinking. What's very opportune is a lot of investors had said, I feel like we've missed this market's really moving. How do we get involved? Have I missed the trade? The answer is no one's missed the trade. However, we had a huge reset. The Ukraine has put a big dent. European carbon's back down to 70 euros. And California is trading at 30. We were at 44 at the highest. So all of these markets have had a reset in 2024, 2023 through 2024, whether that was the Ukraine, whether that was in California, we had policy making get shifted back a year. All of these things have created this great entry point. So right now is the time to do it. We see both of these markets making up sort of significant returns this year and next. And so this really is the right time.
I used to think that this was a green or an ESG type approach. Two aspects to the question. There's a question just coming from an attendee here. But is it green? Is it ESG or is it not? And then Darren asked, what if the government changed their climate targets? How do you predict and analyze the government target setting to analyze your risk exposure in the short to medium term? I mean, we're seeing a lot going on politically. There's been a shift. Where does this sit?
Yeah. Well, so I'll answer the first one. This investment is arguably simultaneously nothing to do with ESG and also the most ESG. I mean, if you're serious about ESG and you want to have real impact, then this is the purest form. I used to say this isn't ESG, but it's also a capital E and a capital G. This is environmental governance. This is a government-run mechanism. It couldn't be more governed and transparent and structured, and it has the greatest impact. As a capitalist, what influences behavior? Pricing, and this is a price mechanism. So it's very interesting because I think this is your capitalist's environmental play, both as an investor and as a politician thinking about this. You don't want to have bans and tariffs and taxes that penalize business. You want to create a price incentive for businesses to innovate. So I could answer that a different way and say it is if you want it to be. If you want it, if ESG is important to you, there's no better way to express that. And we have investors that overlay this over their equities because they say, look, I can't not own oil companies because they're too big in the benchmark and I'll have tracking error if I don't hold them. But I will hold carbon as an overlay to sort of decarbonize. On the other hand, if you don't care about the ESG stuff, you must care about 20% returns with a 0.7 Sharpe and a 0.3 correlation to US equities. That can't be ignored. So long story short, it is if you want it to be. It's very ESG, but if you hate ESG, being ESG was never part of the investment pitch. The investment pitch was high expected returns with low correlation. So that's why I like it, because I try not to get bogged down in that discussion of is it ESG, is it not? No, it's a great investment. It also happens to be one of the most powerful ways to support decarbonizing the global economy. Then to the question about policy, yeah, I mean that's what we do. So those charts that I showed, these demand supply diagrams, all of our research and following politicians and following shifts in policy and following who's electing, whose roles have changed, what's the political sentiment of the various components. We model that here, and that's how we model how the policy's going to change over time. And so the sort of long and short of it is that these programs, especially programs we invest in, are the most embedded, strongest programs. And while there are some definite shifts, we hear it very clear in the US, but I think in Europe to some degree as well, where there's this sort of shift to the right. At the same time, these policies are not left policies. It's worth noting that Republicans in the US, the one time they were governors of California was the time they put the California program in place. It's not. This is a price mechanism. It's a capital allocation price mechanism tool. So and there's huge revenues created that no one wants to lose. So it is quite protected politically. It sounds like something that politicians are going to fight, argue about, and it's going to be something that sounds like a political football. But the reality is, it raises too much money, it's having too much impact, and it's too established. If you think about all the companies that are in these markets that have had to buy millions, tens of millions of dollars of credits, they want this program to succeed as well, because they're, take RWE, they're so long and have made so much money in this market that they want this market to thrive as well. So we do monitor that. We write a blog every single week. We do these webinars frequently. We write a paper about once every 2 months, a very long form, detailed paper on what's happening in these various markets. So we are all over that. And just a high level answer is these are very well supported. You'll no doubt get headlines and people questioning and debating these programs, no doubt, but they're on pretty solid footing.
Look, we're just about bumping up on the hour mark, so I'm going to ask you this last question about how clients or investors are using carbon trade within their portfolios. Where does it sit? What does it look like?
Yeah. So I used one example here today when I talked about commodities. It's a very simple. If you have a commodity exposure for diversification, split that or replace that with something like KRBN, because it's going to give you that same portfolio characteristic, but with actual real expected returns, like material expected returns. And I mentioned California also has that explicit inflation plus 5% adjustment. So we've seen people look at it as just a commodity replacement. We've seen people look at the Sharpe ratio and the correlations and say, this is a great alt. We need to have this in our alts portfolio. We've seen other folks come to us and say, yeah, we're looking at green investments. And then they learn the upside potential here and say, we the risk and return, we want this as an investment, not just as a green investment. And then we've had people that just simply show up and say, we want we want 20% returns. We want 24% returns. We're not seeing that anywhere else. And especially with our California allocation, you've got something like a 20+% return, but without the downside based on that floor price. And so obviously you have to be careful saying no downside, but there is a floor price. And if it trades below the floor, they don't hold any more options. So the supply tightens even faster if it goes below the floor, and that's what keeps the floor being a floor. So yeah, I would say there's people long as a thematic. There are people long as a sustainable investment. There are people also doing an overlay over equities, so they don't want to take benchmark risk by trying to be ESG or sustainable in their equities, but they'll overlay us. And the client wants to know, I can give you like a ratio. It might be 4 or 5% versus your EM equities, and 3-4% versus your developed equities. And so I think I covered it there. Yes, it's a great alt. It's a great thematic play. It's a pure alpha play. It's a great sustainability overlay play. And so we've seen all of those allocations playing out. And one other thing, when you talk about thematic, is AI. Something that gets overlooked. Some people are named two themes: natural gas and AI. AI is exploding the amount of power that we're using. That's creating more pollution. A clean way to be long that increasing technology and use of power is to be long carbon, because wherever they get their power source from, there's probably going to be emissions that's going to push up the price of carbon. Secondly, a lot of people ask me, I had a journalist ask me the other day, people are switching from trading oil to gas. Is gas the new commodity? And I think there's a lot of truth in that. And how do you play it? Because you can't be long natural gas. It's too expensive. The curve is out of control. So be long European carbon, and that will help ride up that natural gas price as carbon rises, rather than try and do that directly in carbon. So many use cases, but I see a place for this in every portfolio.
Luke, thank you very much for joining me today, and that's a great explanation of carbon business globally. Thank you very much.
Thank you.
All right, thanks to the audience. Don't forget to look out for the recording link in a couple of hours. You'll find that on the Interactive Brokers website. Thanks, Luke. Bye for now.
Thank you.